From the morning reading, the Spider reaches the pre-Brexit resistance area. 7 of 9 sectors moved higher on Friday. XLY, XLV, and XLE were the strongest sectors, while XLF was the weakest sector. Oil futures rose 88 cents to close at 49.28. Breadth weakened compared to the prior day as advancers led 1909 to 1088 on the New York Stock Exchange and led 1563 to 1001 on the NASDAQ. Up volume was oppressive again on Friday. It was 3 times heavier in stocks that had advanced versus those that had declined, marking the 4th day in a row. When stocks had recently been at a multi-month low and then saw a breadth surge like this, they tended to keep rising in the medium to long term. Despite the good days, there were still signs of skepticism. Fear-based ETFs have still been showing heavy volume, and small speculators pushed their bets against the major indices to a near record again. The reversal during the week caused a big drop in uncertainty. The VIX fell more than 10 percentage points for one of its biggest weekly drops in history. It was a highly unusual drop, especially considering how low the VIX already is, but future returns after similar drops when the VIX is low led to strong returns. Short-term optimism on silver is at a maximum. The optimism index for silver, SLV, closed at 100 on Friday, only the second time in its history. The other was in November of 2007, after which it dropped about 6% over the next week. With optimism over 95, the fund's worst performance tended to occur during the next 7 to 10 days, suggesting a high risk level for those looking to buy into a market that is generating a lot of interest. Hello, this is Stephen Harris, a head trader from Falcon Global, where we model best practices for investors, traders, and day traders from entry to exit every trading day. In this daily video, I'll provide my opinion and insights of current market trends, market timing, volatility, and hedge risk levels for the upcoming day in the key U.S. financial markets. It is 6:24 a.m. Mountain Time, and I'm recording this in preparation for the market day of July the 5th, 2016. Full disclaimers are at the end of the video, but be aware that this is for educational purposes only, and only you are responsible for the investing or trading decisions that you make. So let's go ahead and dive into the morning report. And we've had some weakness in the overnight, and fairly significant weakness. At the time of this cut, the S&P futures were down some 14 points, or about 2/3%. Russell futures were down a little more than 0.5%. NASDAQ was down about 2/3%. Dow down a little more than 0.5%. Crude oil down sharply, about 2.7%. Euro up just above scratch. Bonds up well over 1 point, and gold up about 0.8%. And overseas action, you have China up about 0.5%, Hong Kong down about 1.5%, Japan down about 2/3%, Germany down about 1.8%, and United Kingdom up just above scratch. In macroeconomic reports for today, we do have a big week, but the start of the week is pretty quiet. Of course, no action yesterday in the United States with the financial markets being closed. We do have factory orders for today, and looking forward to tomorrow, we have ISM manufacturing PMI, FOMC meeting minutes, and manufacturing PMI. Let's see, trade balance also in there. I thought there was something else going on in there, and we got ourselves all mixed up. So in terms of market condition, current volatility trends are showing the VIX is really being crushed. One of the morning authors mentioned this as well. Short-term VIX down to an 11.85. And if you consider where this was not too long ago, this is really a classic case of a volatility crush. Skew also dropping just below or just above the warning threshold of 125, but dropping significantly from where this has been last week, currently at 128.5. IV percentiles all back down into very, very low ranges. And the S&P, it's a 14, the Russell 22, the NASDAQ a 13, and the Dow a 9. Friday marked the first session that we did not have a standard deviation size move across the 4 indices in quite a number of sessions. And if you look at the Dow, that went back some 6 sessions. Same thing with the Russell. But no standard deviation moves were put in on Friday. That was pretty much expected. Usually activity before a major holiday weekend like that, we'll see the markets will trade a little bit the first hour or so, and then usually pretty much go sideways, especially after New York's lunchtime. In terms of the charts, let's go ahead and bounce over there. And I'm using the S&P futures because the overnight activity was pretty significant last night. Right now, this would be a bearish engulfing and a reversal sign on the short-term charts. We'll see where this goes once all the market participants come in. We often will see from a seasonality standpoint a bit of bullishness heading into the 4th of July holiday and then a little bit of bearishness after the holiday. So not a bit surprising thus far. Also, we've gone a very long way, call this 1980, all the way to the Globex high. Guess what? Touched right to the area of resistance. You know, we've had this box drawn for a long time. Touched right to the area of resistance and then reversed in the overnight, and right now is down quite a bit. I think we said something about nearly 20 points. That distance, though, that 1980 up to about 2105, is a very long way to go without any kind of retracement. So that there would be at least some sideways consolidation isn't inspiring in any way, and really doesn't even hurt the short-term bullishness of this pattern. The concern is really the number of times that we've gone up against this area of resistance and failed, including 2 recent swings. So we continue to have difficulty in getting through this area, and we'll have to see just what does it take to get up there. As such, pot odds, it's a very difficult place to enter, and I believe one of the morning authors mentioned about silver. And when you get, you know, one of these situations where you have these big moves and you get huge optimism, it's very, very difficult to buy in at that location. Now, obviously, these things can continue to expand. So it just kind of begs that if you're going to buy in on a parabolic move or a big breakout that is, you know, exploded past, it often begs to use some sort of hedged position or defined risk option strategy, or to perhaps scale in and kind of tiptoe into the position. But right now, pot odds to the long side for the S&P, pretty tough, and obviously lots of room to the downside to the areas of primary support. So probably going to be a little choppy here, at least for today, in terms of being able to advance anything for the bulls. If we look at the Dow, very much the same pattern. Again, a bearish engulfing on that short-term pattern to get us started here, right over here. And then on the NASDAQ, we'll take a look at that. Not quite as bearish, but it's a dark cloud cover, which is also another bearish candle, just not quite as bearish as a bearish engulfing candle. And then on the Russell, we have a clear reversal sign there as well. Right now, this would look like a spinning top, and looks like we're reversing there as well. So all 4 of the broad market indices, based on Globex activity, would seem to be rolling over. And one thing I just thought about, this activity, this candle here, this actually represents the little bit of trading that the futures market did yesterday on the holiday. Now, obviously, cash equity markets were not open, so just keep that in mind. So, for example, we go back to the S&P, this candle right here, well, that one's actually 7.1. This one's 7.5. So I guess what we had here was that the ICE had a little bit of trading on yesterday, Independence Day, whereas some of these other markets did not. Let's take a look real quick at the Dow. That's Friday's candle, and then that's what we'd like to think of Sunday night, but it's actually, in this case, Monday night into Tuesday morning. So this also brings up a good point about trading over these holidays. If you use a lot of support and resistance on an intraday basis, things can be a little muddled when you have a holiday like this, because, you know, some traders will use Friday as their reference points. Other traders will use, if there was any activity yesterday, they'll count it and use that as their reference points. So you end up with a kind of split personality on what traders are referring to, and that can lead to what seems like kind of choppy follow through and setups on the short-term intraday kind of trading basis. So just kind of keep that in mind. Ultimately, no matter how you look at this, all four of the indices seem to be rolling back in something of at least a very short-term pullback, and we'll see how far that might go once the cash participants get into play. Let's take a look at volatility. Volatility, the just super crush that has occurred, and as is typical, if you look back at prior volatility crushes, you get these big spikes, and really in a very few number of sessions, and perhaps this one as a percentage basis is particularly noted, but very few sessions you get quite a bit of the reduction. Remember what led into this? This was Brexit. So you had the huge spike, and then as soon as people kind of started to really comprehend what the Brexit really meant to individual companies, industries, and sectors, they started to kind of deal with that on a company-by-company basis. You know, not everybody is a loser on the Brexit vote. There will certainly be companies that will win on that situation, and that's why you see this kind of breakdown of volatility. So you had on the VIX, it got as high as about 27 roughly, and with the activity on Friday, we got as low as about 14.5. So quite a percent change there in just 1, 2, 3, 4, 5, just 1 week of trading. You had quite a drop. So that also means that premium selling for you option income traders has really scrubbed off as well. Now, along with that, the probability of very large delta and vega moves has also dropped. So it's both easier but less productive in terms of the amount of premium that you can get to trade in the option income strategy at this point. We'll take a look at crude oil. Crude oil also fading a bit in the overnight. We've been in this sideways consolidation pattern ever since it broke out of the channel, and really no resolution to that sideways pattern as of yet. In terms of gold, gold continues to be on its breakout, so that's somewhat interesting. We'll take a look at bonds as well. Bonds also breaking up, and now with, let's see here, what candle. So that was Friday, so no activity on the bond market with yesterday. And then this is, of course, you know, last night coming into this morning. So the two safe haven with bonds and gold are definitely continuing a breakout pattern to the upside. So that would seem to confirm equities moving to the downside in normal relationships between those markets. Okay, let's go ahead and go to our daily report. We're waiting for this intermediate term phase opinion to change. And right now, obviously, with the market backing up, it would seem to reinforce this still holding on to phase 5. Normally, we wait for these patterns to develop over a bit more time. And this last week, we had such a sharp V bottom reversal, which ripped up and now is seemingly coming back. So it's hard to have a lot of confidence in where this is. This is, You know, there is a subjective matter to being able to make a judgment as to what this market phase is using the judgment of the definitions that are involved in these. So right now, because the period of time was so short in the pattern, I've left it alone at phase 5, which is a bearish phase. Well, so we'll see if this can resolve this coming week and give us some better clarity and understanding as to what our market trend intermediate term phase opinion is. But right now we're going to take this as bearish. In terms of the 3 market timing signals, we did get some additional clarity out of this last week, and with the very, very quick reversal on the first one from IBD coming back to confirmed uptrend. Also with Friday's action, that popped the GMI index back to a buy signal. Now that author commented that he likes to wait a few days, especially after such a short-term reversal on this signal. So these have been really, really choppy of late, flipping back and forth in a kind of whipsaw, going to sell, back to buy. So hard to have, you know, extreme confidence in these signals in this sideways range-bound market right up against the area of resistance at this point. But from a mechanical standpoint, you have to give credit to the bulls that you now have 2 of the 3 mechanical signals in the buy signal side. Now the third one comes to us from decision point scoreboard from stock charts, and we've had a couple, actually 3 short-term signals with Friday's action go bullish. So this was on the short term. Prior to that, it was neutral to bearish, and those signals have started to flip back to bullish. Now, intermediate term is somewhat mixed, with the NASDAQ at a neutral to bearish, the others still bullish, and then the long term in a mixed signal. So very, very poor stack here is the bottom line. We like to see all this in agreement, all pointing the same direction between the 3 time frames, be able to take what we feel are long-term trend trades that can really mature and move somewhere, actually gain something of significance. It's been months since we have seen that kind of stack. So this continued to tell us to expect more chop and more volatility and more kind of poor follow-through, especially for those bullish signals. So when you put all this together, you probably have a bit of a bias to the bull side, but an awful lot of you know, confusing whipsaw kind of activity. So don't get too far ahead of these signals. These signals are very, very weak in their signal strength as it stands right now. Now, also mechanical is the position sizing opinions, both from a portfolio and from a volatility model, and both those are currently at 100%. Intermediate term market posture, strong bull at this point, with the S&P and the Dow both have turned up, as well as with there being signaling up over 50. NASDAQ and Russell are also in weak bull, but you know, not that far from 50. So you know, certainly starting to show signs of improvement, certainly compared to being in strong bear. So while all these signals were quite bearish in that week, immediately after the Brexit, they've all kind of eventually turned around and started to show more bullish signs as we've ripped back towards the top of that range. Current strength of trend is a strong bullish trend according to this indicator, though we've had a lot of wiggling, but it's still managed to stay above 80 during all this recent activity. Hedge warning status currently a level 1 plus. We had at some points last week been at level 2. We've come down half a notch to a caution light on the hedge warning status. The VIX, in terms of special opinions, strategy opinions, the VIX is in the acceptable window to initiate new positions for novice traders. Just keep in mind we're up against that area of resistance, so that might want to shape your strategy as you enter. Covered call strategies, put selling, conditions are acceptable in both, but you might want to consider a very defensive setup right now. 2 in the money for every 1 out of the money, 2 low beta for every 1 high beta. consider legging into cover calls with conservative setups with well out of the money put selling. Conditions also for put selling. Perhaps this is even smarter at this point, coming in with a put spread, especially with defined risk and position size and the scale that you're willing to own given the current market conditions. Now, as we mentioned, things started to improve, of course, last week, and many of these volatility-based warnings have ebbed back to kind of normal settings. This was all red, and trend-based also, all those indicators were red at some points last week, but now, you know, basically everything is almost back to normal. We still got skew just barely above warning status, so that one's still in warning status. In terms of trend-based, you still have this intermediate term market phase as phase 5, which is bearish. As I mentioned earlier, though, this one's a bit confused, as it were, right now, so we don't have a lot of confidence in that signal for the moment. Now, one we do have a lot of confidence in is this intermarket risk aversion indicators, and that's usually the first one to show, or amongst the first of the indicators to show us a change. And these lower 2 or 3 have started to show, you know, some activity of rolling up, but not yet crossed over. And you remember this last time they crossed over, went all 5 risk on, and were immediately snuffed out by the Brexit vote. So right now they're still in a risk off status, so keep that in mind. I should mention New York Stock Exchange for the new highs, new lows for the 1 month. We did have a strong bullish signal on Friday with 495 well up over the 300 threshold to be a signal. In terms of sentiment, stocks short term are coming into today with a bit extreme on the sentiment at an 8. And we also have the fear and greed index getting up here into relatively extreme levels at a 71, and actually at a 75 it does go officially into the extreme greed category. So based on that, we start to watch for reversal signals, and, you know, as we talked about when we looked at the charts right now, based on Globex activity, we are absolutely seeing those bearish reversal candles on the short term. In terms of percent change, a lot of healing here, pretty much a sea of green, some neutrals in the short to intermediate term. Obviously, this has been getting whipsawed back and forth. We'll continue to focus mostly on those 3 sectors that have held up with the best consistent performance, and that would be utilities, consumer staples, and telecom overall. Now, on Friday, it was a bit more of a high beta day. And with the exception of telecom, you know, most of what it was at the top was this higher beta rotation. So kind of keep that in mind. Now, one exception to that is financials. Financials continue to kind of struggle in the post-Brexit environment. In terms of the relative rotation graph from the end of last week, we continue to see with some exceptions, FDN, the Internet Index Fund, continues to strengthen and move now from the upper left to the upper right quadrant. This is the strongest place to be, and FDN's coming into that in a strong posture with a rising and leading into this corner. This right here would be, you know, as strong as it gets. And right now FDN is making that kind of move, and really now IYR is, you know, been whipsawed back and forth a little bit, and IYZ as well. That's telecom. We talked about telecom with the sectors just a moment ago, and then IYR actually is on our attention in the trading room for today with respect to an ETF core portfolio strategy. So members of the room certainly aren't surprised by what we're talking about with FDN and IYR. We already have a position in FDN, and IYR we're getting ready to have a position in. So these are all you know, pretty much expected performances out of those areas due to their activity on our watch list. That should be enough for today. Let's go ahead and roll this up. We're always a little long in the first session of the week because of all the activity over the weekend and the great morning reading material that we often get over the weekend as people have a little bit more time to study and analyze the markets. So let's go ahead and get to the disclaimers. Hit the pause button if you need more time to review the disclaimers, and always note the full disclosure that can be found at this hyperlink down here at the bottom. In the meantime, we'll be back here for the next trading session from Falcon Global with our market preview, and keep that risk in line and good trading.